Hello, welcome to another stock analysis, and today we have Embraer. This is a Brazilian-based aerospace company that started in the 1960s by the Brazilian government, but then went private in 1994. So we're going to take a look at their financials, look at their revenues, their cash flows, look at the balance sheet, and give an analysis of what we think of this company as far as the quality of the business, and then we'll do a discount cash flow to see if this company is overvalued or undervalued. So let's dive right into it. We have Embraer. So over the past 5 years, they had a pretty steady uptrend, I guess the past 3 years. Down years in 2020, of course, COVID year for aerospace and airplane companies was pretty rough. So we have an uptrend consistent from there starting at about midway 2022. So right now trading at $35.72. with a PE ratio of 17.34. So we'll look into it to see if that PE ratio makes sense for where the company is right now. Now, this company is, I'd say right now in their mature state. They've been existing for a long time. So again, this company was started in the 60s and they make a business and private jets. They're not really in the commercial space now, but mostly business jets, private jets, and some military. So right now they're in the mature state. So we don't necessarily expect to see a hyper growth going on in this business, but we do want to see some consistent growth as time goes on. So let's take a look at the revenue segments. Just look at the breakdown of where the money is coming from. 75% of their revenue comes from aircraft. We have 10% for spare parts, 15% for service, and a small amount in their other sector. So mostly aircraft, again, business and private jets. Let's look at their revenue trends. Looking at their revenue trends, we see that this business, 2014, they were at 6.2 billion. Now they're at 5.6 billion. So they're trending in the wrong direction when it comes to their 10-year growth, negative 0.1%. So we don't like to see that. But over the past 5 years, they had some steady growth. So 11% per year for the past 5 years. So we do see that. So that's a medium growth state more recently, but we do see that this company hasn't grown in their revenues since 2014. So that's not the best sign. So let's look at the net income. 2014, 335 million. Last 12 months, $381 million. So look, we see they have this kind of rough patch here in from 2018 to 2022. Consistent years of losses. Now they're kind of getting back into the gains. So again, mature company, I understand how this can happen, and the company still may be a solid business, but I don't like to see those consecutive years of losses for a company who is behind Boeing and Airbus when it comes to private and business jets. They're number 3 in their space, and they had consistent losses. So that's not a good sign. Now, maybe this is a sign that's more indicative of where the industry is versus the business, but the business is still going to be largely affected by that. So I am not a fan of this here. Looking at the profit trends, we see that the profit is kind of up and down again. We have this pockets here, 2017 to 2023 or 22, and then we're starting to see an uptrend more recently, but we have a pretty consistent downtrend on average on the net income. So not a great sign there. Looking at their free cash flows. Now, COVID was a year that wasn't normal. So in the analysis, I ignore that year. I know that's not a normal year. Many industries were impacted, especially the aerospace and the airplane manufacturers. So I understand that's not a normal year. We can throw that out. With that said, looking at the last 5 years, we have a solid growth rate of 62%. More recently, 3.5 years, 44.1% in free cash flow growth. So pretty strong growth over the past few years. Looks like it's from 64 million to 290 million over the past 12 months. So that's pretty solid. Balance sheet. At first glance, the debt to cash flow, free cash flow ratio looks horrible. 2.7 billion in debt compared to 143 million in free cash flow. Horrible. Over the past 5 years, or past 3 years, past 3 years, we got 10.4 debt to free cash flow, meaning it will take them 10.4 years to pay off their debt. And looking at the average, of course, including this horrible year of 2020, negative 54. So this is really bad. It looks like a poor leveraged business at first glance. But looking at it a little bit further, they are in the aerospace industry. They manufacture airplanes. Airplane design and proposal, and the process is a very long process. We're looking at a 10-year process when it comes to inception of a design and actually delivering it to a customer and bringing in profits. With that said, their debt is structured in a more nuanced way according to their industry. And just looking at their total debt, right now they have 2.7 billion in total debt. And these are the years when that debt is due. So in 2026, only 1% of it is due. 27, 2%. Now in 2028, this is where 38%, 31% in 29, and 2030 and after, 29% of their debt right now that they have on their balance sheet will be due. So they have many years before this debt is due. So the debt looks high right now compared to their current free cash flow, but they have debt that is pretty much structured to where if this debt is not due until 2029, so it's going to be due around the time that they should start generating revenues from those contracts that they went and got the debt for. So again, first glance, it looks very poor, but when looking at it a little bit deeper, it's not a bad financial position for them to be in. A lot of this are bonds that they've issued, so they have debt that is flexible, pretty much. A lot of times when companies, if they were to get into trouble, I'm not saying they will, but if they were, they have options to transfer some of that debt to equity and not really have to pay out that debt in cash. So they have solid debt structure right now. So I would say, instead of looking at it and saying poor leverage, doing some more study, I say they're in a properly leveraged position, given that so much of their debt is pushed out 5 years from now and beyond. So with that said, let's move on to the next section, dividends. Now, when we're looking at mature companies, we always want a dividend. If a company is that old and that mature, we want them to be able to be in a position where there's excess cash flows that they can give to the shareholder. However, Embraer is not a consistent dividend payer. According to the sheet that I was able to get, the last dividend they paid out was 2018. That was the last consistent dividend that they paid out. I will say that. When I first did this analysis, since I started, they've actually paid a dividend. So I believe it was about 4 or 5 days ago, they paid a dividend of 13 cents per share. I am not sure if that's going to be a consistently paid out dividend or not. However, 13 cents a share, looking at how they were at 1% or 1 cent per share in 2018, that might have been a special dividend. I just saw it today. I'm not sure, but note that they just started paying a dividend of 13 cents per share that just paid out this month. So this could be them restarting their dividend paying again or not, but this is a bad sign when a company this old, this mature, has to cut their dividend or stop. And it's 2018, so 6 years ago is when they paid their last consistent dividend. So we'll see what they do now, but that is what I would consider a bad sign. Not something that I would be interested in investing in. Shares outstanding, we have a downtrend. We like that. So that's great for a company that this is mature in this way to be consistently paying down, consistently buying back shares. I'll say that. Buying back shares, giving value to the shareholder in this way as well. It's not just about dividends. It's not just about profit growth. You want a company to reduce their shares over time. So we like that. Economic value added. This is a big no-no for me. I want a business that is creating value by keeping their doors open. They're operating their doors. That means based on what they're putting into the company, their invested capital, they're bringing back a return that's greater than what it costs to get that capital. The opportunity cost of the capital and the interest of the debt. I need a company to bring in more money than what it costs to put in. So Looking at ERJ, Embraer, they have a 2.8% return, 5-year average on their return on capital employed. Looking at the weighted average cost of capital, past 5 years, 7.8. That means they average a negative about 5% of losing value per year. So that's a big no. When looking at the industry average, the industry is actually averaging a 7% plus of creating value each year. So we had a negative 12.6% spread. So this company is not in a position where they are creating economic value by operating over the past 5 years. So that's a big no for me. Looking at valuation. So I went to Yahoo Finance and got the 17% growth rate, which is a pretty solid growth rate estimate for the next 5 years. I was reading about some of their contracts that they have with the Austrian and Netherlands government. So they do have some military contracts on the horizon. And I believe that's a big contributor to the 17%. Discount rate, weighted average cost of capital, last 5 years, 7.9. I don't really see this as the highest quality business. So my multiple 12 times free cash flow is my terminal value that I'm looking at. With that said, I think the company may be about worth $33.19. It is currently priced at 37. So we'll have a downside of about 11%. So it's overvalued by this chart, but we're not looking at a big spread of being overvalued. So I would say probably minimally overvalued. So that's just my rough estimate based on what I'm seeing in this business. And then again, looking at this estimate, a lot of times I will look at that estimate and reduce it for safety, or come up with my own based on my knowledge of the industry and other industry reports I'm looking at. Because I don't have as much information on Embraer and what they're doing, I'm just going to go with that 17%. So that's my little disclaimer there of where I am on that. So looking at the industry, Embraer, again, business and private jets, they could challenge Airbus and Boeing when it comes to those single aisle commercial jets, but that's going to be something that would take about 10 years for them to, again, design, start doing some bids and proposals and bidding on proposals and getting some revenues going. So that's going to be about a 10-year play if they're interested in that. So if you're interested in this business, that is something you need to study and find out if that's something that their management is talking about as far as new product offerings. So keep that in mind. So just doing a recap of what we reviewed about this company today. Pull another scorecard. So revenue and margin trends, we have an X. Free cash flow trend is trending positive. It's more solid than the revenues. So that's a good sign. Balance sheet is actually pretty healthy when considering how their business operates. Dividend, not consistent. So we don't like that for a company that's in a mature state. Shares outstanding, that's great. They are buying back shares and reducing that share count, giving value to the shareholder. Value creation, their return on capital is less than their cost of capital over the past 5 years. So that's not a good sign. And then properly valued, they are overvalued, but not by a large margin. So if you're looking to invest into this business, if you're convinced that this business is a solid business to get into, this valuation right now is not a bad valuation to enter if you truly believe this company is going to continue to grow at that 17% or even higher, depending on new product offerings. So that sums up what I think about Embraer. So if you enjoyed this analysis, let me know in the comments, and I hope to see you in the next video.